Unlock the high returns of the expanding venture capital world right here on the Emerging Managers Podcast.
Welcome back to the Emerging Managers Podcast. My name is Scott Kelly, your host and the founder and CEO of Black Dog Venture Partners. And I had a really interesting interview most recently with Salman Azhar of the Azimuth Opportunity Fund and his unique investment strategies focusing on pre-exit secondary markets where he acquires shares from earlier stage investors facing liquidity issues at a significant discount, often 40 to 50%. And in this environment, he's providing a really interesting resource for the early stage investors while getting great returns and less risk for his investors. He targets, growing companies in the 30 to 50% per year growth that don't require additional funding rounds and exhibit positive EBITDA. He emphasizes his industry agnostic approach, valuing diversification and identifying opportunities through detailed investor reports and board information from companies he and his partners have previously backed. He'll be highlighting several successful opportunities and exits in his portfolio during this podcast. One is QSKI, a credit risk evaluation for unbanked companies in undeveloped countries, and he'll have others he'll share. And I think what you'll learn is that a really interesting segment of the venture capital space is providing liquidity for earlier investors and providing higher returns with less risk for his investors. So give this interview a listen, and I'll be back with some of my takeaways. Well, hello, everybody. Scott Kelly, Black Dog Venture Partners, and your host for the Emerging Managers Podcast. And I'm excited to introduce and interview Salman Azhar from the Azimuth Opportunity Fund. Welcome to the show.
Thank you. Great to be here.
Fantastic. Well, before we get into the fund, maybe share a little bit about your background, what you've done prior to launching the fund, and share a little bit more about yourself first.
Well, I started off as an entrepreneur. And then in 2001, when the dot-com bubble burst, I turned into an amateur investor, thought I could really do a great job investing. Lost quite a bit of money and almost quit being on the investment side until I met a person who said, "Lo, it's not that there's something wrong with investing. It's that you're doing it wrong. You're not really learning what needs to be done. You're just like swinging and missing and swinging and missing." So next time the market crashed, which was in 2007 during the financial crisis, I took investing more seriously and more professionally, did diligence, got deeper into the risks, not like, be the optimist that I was as an entrepreneur. And that's when things started clicking a lot better. So I have done, some early to mid-stage investing. But the reason I'm kind of an emerging manager right now is that the strategy that we are pursuing now is completely new. It is very different from what we have been doing before.
Well, we'll touch on that in just a minute. Maybe share a little more about your entrepreneur journey. Tell us a bit about that.
Yeah, so I started off with my brother in medical devices. He was selling and servicing medical devices. And we installed some of the first telemetry units where you can see the central nurses stations in the hospitals. It used to be that there was no such thing as a central nurses station. The nurses had to go from room to room to look at monitors and so on. So that's basically how we started. And I was really kind of like a second fiddle to my brother, learned quite a bit about entrepreneurship, though, with that. One of the most interesting things is that I was at a nurses conference once, and nobody had heard of us. The company name was Swans. So I kind of switched things around a little bit. And instead of telling people about Swans, I said, I'm Salman. I'm from Swans International. Have you heard of us? And the funny thing is, like, about half the people started saying, yes, we have heard of you. And like, there's no way you have heard of us because we are just so small and you're lying. And kind of that gave me an interesting insight to people's character.
That's fantastic. So let's dive into the Azimuth Opportunity Fund. Talk about the thesis. We started to discuss that a little bit, but talk about where you're investing, how you invest, what stage, and your secret sauce that you came upon over the years.
Yeah, so Azimuth started because I'm advising a number of funds, and one of the funds that I'm advising, the GP from that fund calls me and says, "Hey, we have an unsolicited offer for this particular company at the previous funding round size. Do you think we should hold or we should sell?" And I did a few calculations in my head and said, well, I would rather be a buyer of this opportunity? And he said, well, we are like, in the last couple of years of our fund, and we don't have any money to buy. And I said, well, maybe I could be the buyer. And this kind of tells you a little bit about kind of the opportunistic side of me. So I'm more like the kind of person that goes in and sees what the defense is giving me and then scores based on that. So if you're a basketball person, if the defense is giving me 3-pointers, I will do 3-pointers. If the defense is giving me layups, they're guarding the perimeter, I would go drive and make a dunk or something like that.
Sure.
So that's how it started, because the calculations I did is that this company is worth about at least twice, maybe thrice as much as what the offer is. And that exposed me to this whole idea of the pre-exit secondary market. Secondary in the sense this money is not going directly into the company. It is early stage investors that are selling their shares to us. And these investors are selling shares to us because they have a liquidity crunch. So we give them liquidity and they give us a discount. And that discount is typically 40 to 50% very easily. Because these funds, the sellers are funds that are in their last year or so, and they are desperate to sell. So picture this as a dying person, right? A person is dying. And if they are dying, they have to either sell their assets or somebody else inherits them. So these funds basically are trying to sell some of their assets. And obviously, whatever is left, they would basically look for what is called a continuation vehicle in our industry.
Okay. So how are you determining, which ones to invest in? I mean, what's your particular industries or focus that you use, and maybe more about the criteria and how you select those?
Well, that's the hardest thing to do because the sellers are very willing to sell and it's a buyer's market. So it's really a question of how can we best pick the stocks. So between my partner and myself, we have invested in over 300 companies now. Actually, it used to be about 250 or so, about 300 companies now. And that gives us information rights as an investor or sometimes even as a board member. And that's how we pick our companies. And once we pick our companies, then we look for funds that are in their last year or so because they are very happy to sell. And the criteria that we are using is we want a growing company. So a company is still growing 30 to 50% year over year, ARR or other KPIs. They don't need another round of funding so that we don't get slammed with another investor or dilution. We are also looking for positive EBITDA in 2025 or earlier, and sometimes the last do go together. If the company has some cash on hand and has positive EBITDA, then they are unlikely to be raising another round of funding. And then finally, we are looking for companies that we can get 30 to 40 to 50% off their exit value at that particular time.
So with that large amount of investments you made in these later stage, companies, what trends are you seeing? Are you said you're going company first and then looking for the funds that have a liquidity need. So how are you picking these companies first?
Of these companies, we get investor reports. And frankly, about half of them we never hear from. It's about probably about a third that we hear regularly, and we hear, information that is actionable. And so we just kind of take what, again, the defense is giving us, what the information is giving us, study the information of each company. A number of these companies we have backed since the early stages, so we know them well. And while our co-investors are selling, we are on the other side buying because the discount is so great. So we are really, our top of the funnel really is the investor reports that we get, or sometimes the board information that we get. And then at the bottom of the funnel basically is going through all the diligence. So we do complete diligence typically because we know these companies very well. They give us access to data rooms and a lot of information that is not out there in public, which gives us an information advantage over everybody else that is doing this. So we are able to identify companies like SpaceX and stuff before they become public information and get much better pricing on it than you can find if you're trading publicly or once they become household names.
So you invest early, but then you also come in towards the end and make those strategic investments. Is that what I hear correctly?
You're absolutely right. So most of our investments have been early stage. My partner and I are early stage and perhaps mid-stage investors because we follow on to our winners. So strategy for both of us independently. And this is even though we have done a lot of deals together, this is the first time we are co-GPs together.
Mm-hmm.
So we basically, both our playbooks, both of us, the playbooks has been invest in early stage. If the company is doing well, put more money in and try to invest at every stage of the game. So we know the entrepreneurs very well. We know the leadership team. We sometimes have even participated in strategy. So one of the companies, for example, Kresge, which is in financial technology, that company evaluates credit risk for unbanked customers. And the founder of that company, about 8 years ago, helped me develop the fraud analytics course at Fuqua, Duke's Business School. And it's one of the few fraud analytics course that is available anywhere in the world. And he gave me information like, how the domain of the email, like Gmail, for example, versus Hotmail. Gmail is more lendable than Hotmail domains because the credit risk is lower. The typing speed when people are filling out, if the typing speed is too fast or too slow, that is an indication of possible fraud. So there are all these other things that I was able to use in my courses that made it really a practical course. But what I didn't know at that time is that I was developing friendship with one of the most amazing entrepreneurs that I know, who has still growing his business, 12 years into it, still growing it at about 50% year over year, which is amazing because, you see that in early stage, but you do not see that kind of growth in later stage companies.
Touch on that. How are you picking the entrepreneurs? What some of their attributes? And then also, is there particular industries you're focusing on or staying away from?
So in terms of picking entrepreneurs, I would say that a lot of it has to do with intuition, but there are some factors that I look for. I look for resilience. I look for ability. I look for curiosity. So these are probably the three that I look for the most. And it's really more important for me that how they are able to develop and go beyond what they are right now, as opposed to what they know right now. And this is basically where, my view of entrepreneurship is very different from like the standard view of employee. And when you are applying for a job, not you and I, but when people are applying for a job, usually they are interviewed based on their skills, not their potential. And I look at entrepreneurs in terms of potentials in this.
Yeah, in terms of industries, are there particular industries you're focusing in on, or maybe ones you're staying away from?
So no particular industry focus. In fact, intentionally agnostic because that automatically gives us diversification. I'm not the kind of investor that says I'm going to just invest in fintech or health or pharma, because actually I think that's a bad idea. I mean, if you were investing your money in public stocks, you won't put them all in tech or healthcare or consumer goods or whatever. So I am intentionally agnostic, and that gives me diversification. I am looking for growth, and that growth typically means that there's some form of technology involved. So it doesn't have to be a tech company. It can be an applied tech company. It can be consumer tech, fintech, health tech. It doesn't even have to be tech. It's just that usually that kind of growth, the 30 to 50% growth I'm looking for, comes in tech companies or tech-enabled companies, I should say.
Okay. So, kind of from a macroeconomic standpoint, we've got the stock market, as of this recording, hitting record highs. After a large dearth, you're seeing some liquidity come into the market and obviously companies going public again. How is that affecting your performance and any success stories you want to share?
Yeah. So, I mean, the stock market being at all-time high actually is a bad sign in many ways. If I had invested anything in the stock market or have anything in the stock market, I would be taking it off right now because there is no reason for it to be at the highs that it is right now. With all the geopolitical issues, just financial uncertainty, inflation, a possibility of inflation and unemployment, at least in US, hitting at the same time. It's really kind of a challenging situation in the stock market. With the IPOs and us have a very complicated relationship. This were a Facebook status, it would be it's complicated as far as relationship is concerned. And the reason is that when IPOs happen, it actually increases the value of our investments, but it decreases the discounts we are able to get on new investments because our discounts are highly dependent on the liquidity that is out there. By liquidity, I mean the cash that is available for investors to invest or give money, return money to the investors. So, for example, Klarna went IPO recently. The IPO was delayed by about 6 months. Actually, it was delayed even before 6 months, but the last delay was 6 months or so due to the tariffs uncertainty. And when that happened, we were able to get higher discounts on fintech companies for that period of 6 months. Now that Klarna is IPO, the discounts are shrinking. But at the same time, we are closer to exit in all our fintech holdings, which is good news because that means we have more liquidity, which means that we have more money to invest. So ideally, we would like to see the world where there is an IPO, there is some liquidity, we get some cash back, and then all of a sudden the IPO market jumps up again because that's going to give us again discounts, and then we buy, and then the IPO market opens up and so on. So it's kind of like almost like a pump. If you're familiar with how water pump works,
Sure.
I think not many people have seen water pumps because we live in cities now. But when I grew up, I see water pumps which basically take suck water from the earth and then kind of pump it out. So it's kind of like that kind of stuff that we are looking for. Or if you've seen CPR. When somebody's getting CPR, you pump some. So that's kind of exactly the market that is an ideal market for us.
So, with all these companies and your background and some of the lessons that you've learned, what are some of the success stories? Talk about some of the companies in the portfolio that have done well or doing well.
Best success stories that we have right now is a company called Questkey, which is a fintech company that evaluating risk for consumer credit. And they started out of Washington, D.C. because that's where the founder was. Adal, one of my favorite founders. And he quickly realized that the best application of this technology is in developing countries where there are a lot of unbanked customers. Being Mexican-American himself, he took this whole idea to Mexico. And in Mexico, more than half the customers don't, or half the population doesn't have a bank account. 90% of the people don't have credit cards. So that is the right market for something like Questkey. And what Questkey does is basically establishes data using microloans of credit risk. And they have like about 12 to 13 years of data now and curate sort of a period of time. So big and small lenders can actually lend in on their platform. So you can think of it that they have established their own FICO based on their proprietary data. So FICO basically gets the data from a number of different sources and integrates it and pools it and allows people, lenders to buy it. Questkey basically has constructed their own data, which is basically makes a huge moat. Nobody else can kind of like come and take them over. So they are kind of like beating most of the traditional buy now, pay laters and microloan companies like, you and I have heard of, like Affirm and Klarna, hand over fist in Mexico, because their models are more conducive to developing countries where there is less information, whereas Klarna and Affirm are more conducive to US and other countries. So, Questkey can't compete with these companies in US, and these companies can't compete with Questkey in Mexico and other kind of developing countries. So that is one. I have another one as well. Would you like to hear about that? Or
Sure, absolutely.
Yeah. So the other one is a light tech company, and actually I have one of their things here, right here, that basically their product comes with. Yeah, there you can see that. So it's not so easy to see on the camera, but basically this thing that I was using tells you what spectrum you're looking at.
Okay.
And it turns out that light is very dangerous to human health, artificial light, not the sunlight and so on. And the reason for that is that LED lights in particular, even though they save a lot of energy and they have introduced a lot of savings because of that, but they impact health in ways that we never knew that they would. What's very commonly known is that circadian blue is something that hurts sleep. So if you get a blue light exposure in the evenings, it would hurt your sleep and throw your circadian rhythm off.
Okay.
What is not as commonly known is that circadian blue is actually good during daytime. So the way that blue light works is that it suppresses melatonin production, which helps us sleep.
Hmm.
But if we block blue light during daytime, it increases melatonin production, and it is effectively like taking a sleeping pill during daytime. So all these blue light glasses, so these are not blue light glasses, these are blue glasses, blue frame glasses, they're actually very bad for your health because they put you to sleep during daytime when you should be really focused and productive and so on and so forth. What is even less known is that light can cause a lot of other health issues like cancer, Alzheimer's among older adults,
Hmm.
ADHD, depression, anxiety in younger people. People thought that screen time and social media, actually, people thought that social media basically is hurting a lot of mental health of our younger adults.
Hmm.
But it's not just the social media and the psychology of that, but it is also the impact of the light that is being emitted from the screens that we are exposed to almost all the time, and our children are exposed to all the time. So what Chorus does is it is able to take the entire spectrum and control it. So think of it as a smart light with complete spectrum control. So it can now tune the light spectrum so that you have more blue light exposure during daytime and less blue light exposure during the nighttime.
Mm.
And on top of that, this light appears white to you.
Mm.
So we cannot tell the difference between this. So the biggest kind of thing that I'm excited about is that they have perfected the night mode on computer screens, phone screens, and any displays, essentially,
Mhm.
including TVs. And they can take the blue completely out at night, and yet it appears with complete color fidelity, highest image quality, so you can continue watching TV or on your laptop or on your phone without the harmful blue light hitting you all the time.
That's interesting. I'll have to keep that in mind. I've never been historically a very big sleeper, and so I'm always finding new ways to get myself tired for longer periods of time. So, I appreciate that. So,
Yeah.
um, yeah.
Yeah, Scott, one of the biggest delights of me meeting is that I hardly meet people in this industry that have been doing this for longer, because a lot of investors are like one and done or a few and done because they invest and they lose and then they go away. Like I almost went away in the early 2000s. And you've been doing this for a while. And another thing now that I know is that you have trouble sleeping just like I do because the brain keeps on operating.
Doesn't turn off. It does not
Yeah,
turn
it
off.
doesn't turn off. And so I have learned that, controlling light is just one of the aspects of it, but there are a lot of other aspects that are just psychological that, trying
Sure.
to turn, how to turn your brain off and so on. But we can talk
Awesome.
about that more later.
Absolutely. Absolutely. So talk about getting back to the fund. You have two general partners. Do you have co-investors, LPs? What's the makeup of the fund?
So we have two general partners. We have one other full-time employee who is a principal. Technically, he's the only employee. And then part of my role at Duke University is to train Duke University students in venture capital, because venture
Mhm.
capital is something that was very hard to find internships and an entry point.
Mhm.
And a lot of MBA students and business school students are looking for that. So I have a few students every year that are under training, and they help with some of the research for some of the diligence. So, we go kind of complete uh,
Mhm.
old school on this when we decide to invest in a company, and we do complete diligence report on it.
Mhm.
And that's basically what the students and I kind of work on together. My partner both helps with the deal flow because he has a lot, has a lot of board positions and
Mhm.
investor information. And then he also helps with the exit of these companies. And the reason that is important for us is that we are getting 40 to 50% discount upfront. So we are actually making money at the buying portion,
Sure.
which is very unusual to compared to everything we have done before. Now, if we are getting, let's say, 50% discount and we exit in 1 year, we materialize that 50% discount in 1 year. But if it's
Mhm.
2 years, then it is 50% over 2 years, which is amortized to about 25%, not including compounding and
Sure.
stuff. So he basically goes to work in terms of helping these companies exit. Plan A is always IPO. But when,
Mhm.
sometimes the IPO can also be an indication to potential acquirers that, hey, we are this company is ready to go IPO. If you want to really acquire this company, now is the time, because it's a lot easier to acquire a company before IPO than after IPO.
Now, is it just your capital? Is it an evergreen fund? Do you have other investors that are investing along with you?
It is. Oh yeah, yeah. You did ask about investors. So so on a typical deal, we would invest about 10% of our own capital, and then about 90% would be co-investors or LPs. LP
Okay.
as in limited partners, and we have, at any given time, we would have a couple of companies that we are actively investing in, and then in the background we have the fund going on. And this is kind of an interesting thing, and it's a very nuanced thing. Even though my partner and I have like a couple of decades of experience, we are classified as a first-time fund or as emerging managers for two reasons. Reason number one is this is the first time that two of us are working together,
Mm-hmm.
and that automatically kind of indicates to a lot of family offices and institutional investors this is a first-time fund. And the second thing is that this is a new strategy, not just for us, but actually in general.
Mm-hmm.
Even though secondary market has been around for a long time, it has been more of like, you do this in a desperate situation. It's not a
Mm-hmm.
strategy. It's basically, a release valve. And in fact, Mattermark, which was one of the first companies that started secondary market, almost went out of business before it was acquired.
Mm-hmm.
So it's still a very new strategy, the whole thing we are doing, not just for ourselves, but for the
Mm-hmm.
entire world. So that makes the first time lead or anchor LPs the kind of people that put 10, 20 million in, very
Mm-hmm.
gun shy. So we decided to lean into our strategy, which is basically going to our network and finding people who don't have exposure or don't have investments in VC, and say, okay, we are going to do this and we are going to expand our base. And
Mm-hmm.
really the idea, the strategy there is that in our fund two, we
Mm-hmm.
can go for 150 to 200 million, because then we have fund two, we will have all these lead and anchor LPs that will be putting 10 and 20 million or 50 million. But then we'll also have all these little investors who started off with something like 100,000 or 50,000 even,
Mm-hmm.
and got 200, 300,000 back. And now they'll put that money, they'll
Sure.
tell their friends and family, they will liquidate other investments, and everybody will come in. So that's kind of our long game.
Okay. For potential LPs listening in or potential investors that want to invest with you in Azimuth, why your fund? Why now?
Oh, so it's a very simple thing. We make money only when our investors make money. We don't charge management fees on our SPVs.
Okay.
We just charge a carry. We
Okay.
charge for, we ask people to contribute for the expenses, such as, legal compliance and accounting
Mm-hmm.
that you probably are familiar with, but they don't pay our salary on the SPVs.
Okay.
So that makes a very compelling argument, because I can honestly say we make money when you make money.
Right.
And almost anybody that knows me, has done business with me, if they have $50,000, we would allow them to invest. Sometimes we would even allow them to invest 25,000 in two different tranches. And
Mm-hmm.
this really came from my son's friends who are like in their late 20s or early 30s. And they said, hey, your minimum is 250,000.
Mm-hmm.
We don't have that kind of money. We have 50,000. We are making salaries. They didn't say that, but I know, tech salaries, they're
Sure.
making hundreds of thousands of dollars a year. And, but we will invest with, 25, 50,000 with you almost every quarter.
Awesome.
So that's basically we just decided to lean into that strategy, as
Right.
opposed to, the lead anchor LPs that are like 20, 30 million. They're still hanging around. So they're taking time, wait and see approach. But that's basically what
Okay.
bulk of our investors are.
Fantastic. Anything else you want to share with our listeners today?
No, well, I mean, this has been great, Scott. I rarely meet people who are OGs like yourself. I used to call myself an OG, but now I have to really reevaluate that, because you've been doing this for longer. And it's a pleasure talking to you. And if you're listening to this show and you are kind of interested in learning more, happy to contact me. My email address is Salman, SALMAN, then at azimuthopportunity.com. Azimuth, you can AZIMUTH, and opportunity, just like the English word opportunity.com. Happy to continue this conversation.
Fantastic. Salman, thank you for being on the show. For everyone listening today, make sure you archive this podcast, like, comment, and share this with everyone that might be interested. And again, Salman, thanks again for being on the show.
My pleasure.
Welcome back. The interesting thing that I learned in talking to Salman from the Azimuth Opportunity Fund is this emphasis on providing liquidity for early stage investors, as I mentioned before. It really provides an immediate advantage for him in terms of his returns. And, he has a founder-friendly investment model. For people that invest with him, the fund charges no management fees on its SPVs, only a carry and a contribution for expenses. That aligns their success directly with his and the investor returns. And the great thing about his fund, there's accessibility for smaller investors. If someone's looking to get into this type of investment, they're willing to accept smaller investments, $25,000 to $50,000, and that allows a broader range of individuals to participate in venture capital opportunities. But the thing he mentioned and he emphasized was be aware that early stage investors face liquidity crunches. You see this all the time now. It's been in the news constantly. Over the last several years, we've had a challenge with venture capital funds not getting exits and not allowing their LPs to get some exits. And he's providing a unique opportunity for these funds, for these more mature funds to get liquidity for themselves, and then also gives his ability to buy right with some of these companies that are already positive and already growing. So continue to follow us on the Emerging Matters podcast, and you'll hear more great interviews like Azimuth Opportunity Fund. Please like, comment, and share, and we'll see you again soon.
Join Scott Kelly, Tracy Hazard, and their high-performing capital fund manager guest next week on the Emerging Managers podcast. Don't miss our upcoming virtual and live VC Fast Pitch and podcast events. For more details, background on our guests, or an application to be our next guest, visit emergingmanagerspodcast.com. Don't miss out on shaping the future of venture capital and entrepreneurship with us by joining our robust community of innovators and investors today.